Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. The key question that we have for the market is how long is this market cycle going to last? So we're 22 months now into an inverted yield curve, longest in history. The Fed's maintaining interest rates, inflation's not cooperating, feels like the economy is beginning to slow. So how long could this market cycle last? There's clearly some positive underlying momentum behind the market itself. So we're going to walk through also what we're investing in, kind of what we're thinking. And then lastly, artificial intelligence is going to require a massive amount of energy. We think the only way to satisfy this energy need is through natural gas. So the stock market. Key factors for the stock market is the economy and earnings, right? So here's the economy. It slowed down quite a bit. So nicely over 4% growth in the third quarter. Actually, the employment numbers were rather lousy for the third quarter. So those are starting to catch up to the economy now. 1.6% growth in the first quarter of this year. So we're kind of wondering, are we going to dip below 1% in the second or third quarter? And our view of the economy has been for a long time that we're going to start to see a big slowing occur in the third quarter of this year. Maybe it takes as long as the first quarter next year, but we're going to start to see a big slowing trend. The earnings estimates are elevated for the S&P 500. At $277 for 2025. The stock market needs to be comfortable with $277 to go meaningfully higher at 21 times this year's earnings. So this year, we're looking for 11% growth. That's not going to be an easy task to hit. And then you look back over time, has there been growth like this to occur? Yeah, there in 2021 versus 2019. So we take out the 2020 number because of COVID, that was 28% growth. But keep in mind, that was a massive amount of government spending in there. And we have government spending still kind of in these numbers here, but it's starting to temper in a big way in terms of its growth. In 2017, there was 12% growth, followed by 21. But keep in mind, there was a massive tax cut by Trump in that period of time. So what's going to drive this growth here? As I mentioned, 22 months of an inverted yield curve, it's going to be a lot harder getting these numbers. And we just don't believe the 2025 number at all. The 10-year treasury is really important to the valuations. So the 10-year treasury at 4.5%, maybe it's starting to peak out. Not sure, but maybe. The CPI report on May 15th is really important. So you have kind of a mixed picture of the stock market. One is interest rates may begin to come down a little bit, but the growth is starting to slow. And that the numbers for next year and maybe this year as well don't seem to be conceivable. We're going to have the mega cap technology stocks really start to slow down in their momentum. Frankly, I thought the Apple number was horrible. The only thing that drove that stock up was a massive share repurchase announced. Good for them, but the fundamentals of Apple are not great. Technicals of the market. So this is the most important thing in our opinion. So we have kind of a negative view of the fundamentals, but the technicals, they're still in place. So we're cautious about this in general, but you can see here that we had this nice buying opportunity in November or October of last year. Massive run followed by a rollover. So we had this parabolic move, which gave us a sell signal through here, but it held 100-day. So now we're back above the 50-day moving average. We think we should have exposure to the overall markets, but it's not set up very well. This is not a very positive looking trend in our opinion. Although the trend is intact, it's starting to roll over. So if it breaks the 50-day, you got to get defensive again. The NASDAQ, same pattern, exactly the same pattern. Come down, it's actually broke through the 100-day, back above the 100-day, but it's above the 50-day now. The 20-day moving average is below the 50-day. We don't like that sort of feeling for the technicals of the market. If you look at the Russell, same pattern, right? You did break the 100-day back above. We thought this was kind of interesting as it's starting to move higher. We think that the Russell is a lot more interesting than the other indexes as it's below where it was 3 years ago. So it's moved sideways for 3 years now. When this thing moves, it's likely going to move in a big way. Technically, it's interesting, but we don't think the markets are set up in a really good way to own small caps in a big way. We think investors should have some exposure here. Oil's rolled over. Look at this. So roughly $8 has been taken out of the price of oil. This is the war premium that's gone. It's below the 200-day moving average. We're just going to sit back and wait. And we're going to see how far this can go down. So Israelis look like they're moving into Rafah. Maybe there'll be some sort of agreement to cease fire. Who knows? But we don't think Iran is going to do anything regardless of what happens. So we think oil might be trending down here, at least in the near term. We think that maybe support for oil is more down at the $70 level. But if something unusual happens in the Middle East, it pops above 80, maybe it goes to close to 90 again. However, we think that a trend is starting to roll over for oil, and we've pulled back some of our exposure to the energy stocks. Individual stocks. So if you look at the overall indexes, it's a difficult setup. So we don't like the pressing our bets on the individual indexes such as the S&P 500 or the NASDAQ. So we're looking at the individual stocks themselves. We see a lot of quality names, but they look somewhat like minefields to us. So Starbucks reported last week it was worse than expected. It was the last tough quarter, in our opinion, that they had, and it came in below expectations. So obviously the stock got hit, took the bull case out a little bit there. So Starbucks has some work to do. But when you think about Starbucks, it's probably the most consumer frequent store in all of America. This is addictive. However, for a price of a cup of coffee, probably $5 at times, it's probably too expensive. We think that's the reason why they're seeing weaker comps. And they had weaker comps in China. Well, that's a China issue. They'll work through that. The U.S. needs to be resolved. We think this is an opportunity for an activist to come in, take a position, get things righted, and this stock could have a very meaningful move back to the upside. It's at 18.7 times earnings. It's the low of where it's been in the last 10 years. So we think that this is a great brand. It's probably worth 25 times earnings or more. There's an opportunity here, but investors need to be patient with it. It's not going to be a real quick fix, but it's going to probably be fixed in due order. J&J, as you know, we've liked this stock. It's now at the lowest multiple over the last 10 years, 13.9 times. Fundamentals of J&J are good, so they don't have any short-term issues, except for the liability from talc. J&J's trying to resolve that liability, take the overhang away from their stock. The underlying fundamentals, as we mentioned, are good. They're growing nicely. It's the talc liability. So when that gets taken away, I think you're going to see a very nice move in this stock back to a more reasonable multiple. You get 10 or 20% sort of movement out of this stock in very short order. J&J, we think it's a nice value in a great company, and we would be buying this stock regardless of what the settlement is. So it's $6.5 billion now. It could go to 10. We don't think it's much higher than 10. It's meaningless to J&J. They'll resolve this issue, and I think the stock will be back on a growth path. Thinking of wealth management a little bit. So we've got the indexes themselves, fully valued, somewhat questionable in search of technicals, but still upward moving. So you have to kind of go to individual stocks, in our opinion, to find interesting things to invest in. As you know, we really like the small cap biotech, but that's not for everybody. We've made some really nice returns here very recently and over the long term. So at 21 times earnings for the S&P 500, that's not where bull markets begin, right? That's kind of where they end. So the yield curve inverted for 22 months. It's going to have an impact on the economy, and it's coming. So we're looking at themes to play. We like some conservative, high quality companies like J&J, and then picking off some of the fallen angels as well. Small cap we like a lot, but it's, don't take a big position there yet. And then a major theme, and we're going to have more about this in the coming weeks, but a major theme of solving an energy need for artificial intelligence is natural gas. And look at this chart. This is from 2002. So anytime it hits around that $2 level, it's a great opportunity to buy natural gas. So in 2002, you could have bought natural gas at 2.25, and it went as high as $12. Okay. Again, back to 2.25 in 2012. You had a spike back to $5. Similar pattern in 2016. 2020 back to the same level. That went up to around $9. Now back to under $2 it was recently. We think that without question, we don't see another way of fixing the energy needs for all the huge demand of artificial intelligence. It's not going to happen via nuclear. Nuclear is too cumbersome. There's too many issues around nuclear. Although we think that's an interesting idea, it's also too expensive. Energy needs such as solar and wind are not there yet. So it'll be many years before the energy needs they take more market share from the traditional sources. So we think that natural gas is the way to play it. There's some really interesting ways to play natural gas. It may take some time to play out, but in a market that is overvalued, has economic risk, we think that the natural gas area is a very attractive area to start putting some money to work. Please hit like, subscribe, come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute. And if you have any investment needs, you want to talk to us, just send us an email via our website and just ask your questions or set up a call. We can do a conference call to discuss what we're doing. Take care.